Welcome back. The other day, wholesale inventories were reported to have decreased, but only slightly, and still remain very elevated. And it really plays into the decision the Federal Reserve has to make. And we're going to see tomorrow inflation numbers that might reflect this. But first, wholesale inventories. They measure the change in goods held by inventory by wholesalers. The inventories are reported in millions of dollars, with the exception of metals. High and low inventory levels reflect strong or weak retail demand. Essentially, when inventories rise, it means wholesalers can't get rid of this stuff. It's not a good sign for the economy. When inventories are low, it means there's good consumer demand. The economy is strong, and wholesale inventories go right into determining the strength of gross domestic product. Now, we'll take a look at a number of different sectors. This is on a month-over-month basis. The change. Petroleum products down 3.1%. Inventories dropped. That's a good thing. Inventories went down. Petroleum products. Motor vehicle parts and supplies, which we see is very resilient in a negative way, up 1.1% since last month. Farm products are down 2%. Those were very strong. Alcohol, beer, wine, distilled beverages, that's down less than 1%. Apparel's down almost 2. So is software, about 2%. Biggest drop are the metals and minerals. That's down 3.5%. Machinery's up. Machinery's also been very resilient. And then lumber, construction, chemicals, down 1 and 2% respectively. So we see there's been overall, for the most part, a decline, but we're going to see in the moment, the charts show we're still very resilient. This is the overall durable goods inventories. Now, again, durable goods are those products that are designed to last more than 3 years. Everything from aircraft, washing machines, computers, long-term goods. The white line is the S&P 500. And we can see up until late 2021, there was a positive correlation when stocks went up. So did the durable goods inventories. Now, there's not necessarily a direct correlation for logical reasons. I think this just sort of happened because if you remember, after 2019, the 2020 COVID crash, there was a real buildup in inventories. The inventories we would expect to drop with all of this excess cash as a result of the savings. We're actually going to talk about that in the next few days or weeks about the excess cash, which is one of the reasons why a lot of analysts think that we have not entered a recession because there's still a lot of COVID cash out there. Here are the inventories for petroleum products. We did have a pretty significant high mid 22, but since then has pulled to the downside. But as we can see, even prior to the COVID dip of 2020, we're still pretty significantly higher than we were 2019, 2018. Here's motor vehicle parts and supplies. There's been a lot said about the used car market and how used cars are more expensive than, what new cars used to be. Motor vehicle parts and supplies is probably the highest level we've seen in a very long time. This is not good. This is a negative. I think that the higher interest rates, well, it's not necessarily slowing down the housing prices. I don't want to say the velocity, but the prices aren't coming down. But motor vehicle parts and supplies, I think, are being hurt by these high interest rates. Farm products and materials related to the farming industry, a huge decline off of very significant highs. If you recall the inflation numbers from last year, the price of eggs and milk were up very, very high. The inventories built up, but now they really have been absorbed, maybe because food prices have come down. We're going to see tomorrow inflation numbers. Core CPI, excluding food and energy, is one situation, but the overall number, we want to see that decline. And that would reflect uh, weakening or softening cheaper, you know, products in the supermarket. Here's beer, wine, and distilled alcohol beverages. Good news for some. Lots of inventories out there near the highs. This, in some cases, can be considered a luxury good. Maybe there just isn't as much disposable income out there for these kind of things. Here's apparel, which is also considered a luxury good. Coming off of its highs, we reached late 22, but still very, very strong. You'll see a repeating pattern. Motor vehicle parts and supplies at their highs in terms of inventories, apparel just off their highs. There's a lot of inventory out there. Now, that cannot translate well for the stocks in the S&P 500. The fact that the stock market is still quite strong, relatively speaking, it does not reflect the inventories. Here's computer equipment and software. That has come down a lot. But we know that computer equipment and software, that can be discounted very easily. Computers always get cheaper over time. Metals and minerals are down, surprisingly, with weak gold prices and silver prices lately. But nevertheless, these inventories have been declining. Maybe there's been more of a flood into the metals, in light of all these interest rate hikes and the concern of maybe a weaker currency. Here's machinery, equipment, and supplies at their highs. Notice a very similar chart to what we saw with auto parts at their highs. This seems to be hurt by higher interest rates. The inventories are at their high because a lot of these machinery and equipment and supplies, they're financed, and when interest rates go up, it's more difficult to finance them. Here's lumber and construction materials. Now, the inventories have come down. I think this is more closely related to the housing market. There's a real lack of inventory because sellers just don't want to walk away from a very low interest rate loan. So I think the inventories are coming down. Here's chemical and allied products. Also, similar, I think, to the lumber and construction sector. Here are the overall industries that we can see. Now, the orange line at the bottom, that's the farm product raw materials. The inventories did come down quite a bit. They've reversed course since hitting their pretty significant lows March, April of this year. But relatively speaking, they're still probably one of the weakest industries. The industry that looks to be really the weakest are the metals. Notice this brown line really heading lower, along with the light blue line, which are chemicals and allied products. Also, lumber, of course, is weakening as well. The white line at the top, that's motor vehicle parts and supplies. And the red line right next to it, machinery, equipment, and supplies, also very resilient. And I think that's the name of the game here, is that we see those industries with the highest amount of inventories are the ones that are most being affected by high interest rates. Auto parts, and also machinery along the same lines. Now let's take a look at the actual numbers over here. These are inventories for the durable goods. That's the main number. Now these numbers reflect a year-over-year change. Now, again, when the number goes up, it means inventories have risen. And when inventories go up, it shows us lack of demand from the consumer. It's a negative. So the higher the number, the more it's going to weigh on GDP. And by the way, we're talking so much about the Federal Reserve these days. This is a major component that the Federal Reserve looks at, aside from inflation and the jobs, are the inventories. They want to see how fast the consumers are able to scoop up these products. So when we see the overall durable goods up 15%, 13%, 11% on a year-over-year basis, yeah, I know it's slowing a little, but on a year-over-year basis, the inventories are still continuing to rise. Imagine we had a factory full of durable goods and we have 9%, 7% more than we did last August. Well, that would not be good for that company. Now, petroleum, of course, it's coming down 17%, 16%, and that should be reflected in the CPI. The CPI Consumer Price Index is basket of goods and services, it includes petroleum. Now, if you take a look at this, if we want to play the guessing game for tomorrow, what will CPI be? Well, based on this, core CPI, which excludes food and energy, maybe that's going to be strong. The headline number is going to be strong, but, or I should say, core CPI will be strong, excluding food and energy, but including food and energy, the core number, that might be weak. If the market pays attention to the core number, that may lead to the conclusion the Federal Reserve is less likely to raise interest rates. We saw yesterday the Fed funds futures indicate an 86% chance that the Federal Reserve will not raise interest rates in their September meeting. Let's make a mental note and see if we're right on this. Petroleum has been weak, and that goes into the headline number. Maybe the headline number will be weak as well. Of course, though, we see motor vehicle parts. That's up 19% year over year. Now, of course, we're in August now. We're looking at the June number. It's always delayed a month. 19% since last June, 21% the prior month. By the way, let's take a look at petroleum and motor vehicle parts, and we can see what we've experienced, let's say, since the COVID crisis. Now, the COVID crisis, that was March of 2020, right? All of a sudden, the inventories plummeted. The inventories plummeted and then obviously recovered as I think that we're now entering a more difficult period of time. During low interest rates, and maybe this is one of the reasons, maybe during the low interest rates of early mid 2020, remember the Federal Reserve chopped interest rates aggressively after the COVID stock market crash. Maybe that led to consumers really scooping up a lot of these inventories. But remember, since inventories started to rise in light of higher interest rates, maybe this really slowed us down. Now, in particular, take a look at June 2021 and now June 2022. What happened between June 37% to June 2022, 26%. But since June of 22, we've come down and now we see a reduction. But we did see a massive buildup in the inventories. Now, it's always curious to see, of course, we all remember what happened in 2008. Let's look to see what happened. This is January of 2008, right over here. That's petroleum, and these are motor vehicle parts. Now, as we entered that 2008 recession, all of a sudden, inventory, especially for petroleum, went through the roof, but also for motor vehicle parts. Inventories went up 12, 13% on the motor vehicle parts, 44% August of 2008 compared to '07. That was a big difference. That's a lot of inventories built up. But then as we entered 2009, the stock market hit a low in 2009, March. And then all of a sudden we saw the inventories completely depleted. Why? Federal Reserve cut interest rates, quantitative easing, and a lot of other Fed programs. And that led to a huge reduction in interest rates. Compare that to present day, we had a huge buildup in inventory in motor vehicle parts and petroleum at this point. Now we've seen a reduction. But what's curious is, these are very closely related industries, petroleum and motor vehicle parts. Why are inventories for petroleum? Maybe, you have an opinion about this. Why are inventories for petroleum decreasing while motor vehicle parts are not? Maybe it has to do with interest rates. Interest rates might be the whole story here. Interest rates affect, we finance motor vehicles. We don't finance gasoline, you know. So maybe that's one of the reasons, but very curious how we see a divergence. Usually we see these two industries move together. At any rate, we will see inflation numbers for the rest of the week. We have a 2% Fed inflation target. The last CPI was 3.1%. If our theory is correct, that the headline number should be weak because we see plummeting petroleum inventories, maybe we'll see a weak number. But it'll be very interesting to see in either direction. And we'll be certain to report any significant changes along the way as well. We hope this has been helpful. We look forward to seeing you back soon.